Tech stocks are leading the market higher today after the U.S. Senate indicated an end to the government shutdown is in sight. Let's go to Justin Elliott on this, portfolio manager at Caldwell Investment Management. Justin, thanks for joining us today.
Thanks for having me on.
We've got a bit of a rebound going on after last week's volatility. Do you think some of this, at least, is coming from a hope of an end to the government shutdown?
Yeah, absolutely. I think that's been, just sort of one headwind to the markets. It's been one of the longest government shutdowns really in history. So it's good to kind of open that back up, get funds flowing through the economy again. We saw news last week, for example, that October had the largest pace of layoffs in really, kind of a multi-decade period. And so there's definitely a lot of concern over, sort of what's going on in the economy right now. A lot of talk about a K-shaped economy, which we kind of look at in two ways. There's sort of the consumer side. So the low-end consumer is struggling a little bit, while the upper-end consumer remains robust. And, tied to this government shutdown, for example, you have the reduction in SNAP benefits, federal workers not getting paid. And so we think that's definitely a point against sort of the, consumer side of the K-shaped economy, the lower income side kind of not doing so well. So this should definitely make things a little bit better and, keep things going kind of back to normal.
Okay, we are still getting earnings coming in. What is your take on what we've seen so far? And if you could separate out AI from others.
Yeah, it's, expectations were pretty high coming into Q3 here. And overall, on a broad level, the market delivered. It was the fourth consecutive quarter of double-digit earnings growth. And if you look ahead, there's still the expectation for kind of mid-high single-digit earnings growth heading into 2026. So, again, like you said, I think a lot of that has been tech-driven, and the Mag 7 has been a really strong driver of earnings growth. And an increase in earnings estimates. If you kind of look year to date, basically the Mag 7 was responsible for all of the increase in the S&P earnings estimates for the year at the aggregate level. The other, 493 stocks are kind of down ever so slightly. So it's been really a tech-driven story. That continues to be kind of the dominant theme in the market. But again, really strong earnings coming out of, that group. The fundamentals are still there. They still see a reason to invest in AI CapEx, for example, just with all the demand they're seeing. Demand still very much outstripping supply. And so we think, that's been a key driver. As long as they can continue to sort of put up the results that they had been, that can keep markets coming along. Obviously, we'd like to see the breadth expand a little bit, and we'd like to see, more earnings growth in kind of other sectors and more broad-based. But things seem to be holding up okay for now.
Yeah, in fact, you've said there has to be growth. That growth has to spread for the AI bubble not to burst. Can you explain a little bit more around that?
Yeah. So again, I think, for example, today it's still very, very early stages in terms of AI adoption at the enterprise level. And so for the hyperscale companies continuing to invest, to that future demand, they see that, we're really early stages. There's more of a risk to not investing now and being behind in the future, as opposed to over-investing and, just having that capacity that they could still use internally. For the rest of the market, right, and for some smaller companies, even within the S&P, I think things have been more challenging, for example, on the tariff front. So being able to pass along those price increases, being able to be nimble with your supply chains and kind of reshore and move things around, it's been trickier for the smaller companies. And so we've seen really that power consolidate in the larger companies that have, the free cash flow to invest in CapEx, invest in R&D, invest in kind of broadening out their supply chains. And that is compounded back to them in terms of being able to capture demand sort of better than the smaller players. So we think we're kind of in this environment where larger companies are, kind of consolidating power and building on their strengths at the expense of some of the smaller companies.
Okay, let's get to a couple of your stock picks. Interactive Brokers is the first one. I think it's a $120 billion company. Does that sound right to you? What do you like about them?
Yeah, absolutely. And so they're basically one of the leading electronic, brokerage providers. They're available in over 150 markets over the world. They trade in all sorts of currencies and really all sorts of asset classes. So as it stands today, they've got about 4 million accounts, but globally they see anywhere between sort of 70 to 80 million, what they call more sophisticated traders, right? These are traders that have, maybe a couple $100,000 in their account and sort of manage their own money. So really low penetration in terms of that international growth opportunity. What we really like about Interactive Brokers, say compared to a Schwab, for example, is they've always had a very intense focus on keeping costs low and automating as much as possible. And what that does, it allows them to offer the lowest costs. That helps drive new account growth. And then it also allows them to invest in, the best offerings for their customers. So it's kind of this flywheel that builds upon itself. And that also translates into industry-leading margins as well. So they have, above 70% pre-tax margins, largely because of their focus on automation and running a very lean cost structure. And so, we really like the business. We think there's a long growth opportunity, and it's going to come at high margins as well.
Okay, I do want to get to another pick. You like eBay, and they're using AI. How are they using AI? How is it benefiting them?
Yeah, so eBay, just for those not familiar, they're the second largest marketplace in the US, actually. They do about $75 billion a year in gross merchandise value. And they've been using AI to really improve access to their platform for sellers and buyers alike. So if you're a seller, they've used AI tools where you can simply take a picture of something and it will create a listing for you and save you the hassle of having to write all that stuff out and create a description. So that allows you to really go through things that you have been wanting to sell but are just too lazy to maybe put up. It speeds up that process. On the buyer side, it helps with kind of the search function and getting what you're really looking for. So, it's really targeting more so what you're looking for on that platform and kind of driving that conversion a little bit higher. But, what we really like is they are a leader in a lot of these niche categories, these focus categories, they call them, that have been growing faster than their core business. And that is really, a network effect that we see building just because they have the largest kind of offering for a lot of these products. You can think about, designer handbags, thrifted goods, things in the circular economy. And so they have the largest offering there. They authenticate these sort of products that you might not get on other marketplaces. So we think that also drives people to the platform. And that's helping drive kind of their business and drive that merchandise value growth. So we think they're kind of a leader there and somewhat underappreciated. And we think the AI is going to help, drive more people to that platform.
Authentication is key, especially right now with people worried about getting scammed all the time. All right, Justin, I got to leave it there. Thank you for your time. Appreciate it.